Welcome and thank you for joining in. In this video, we will talk about bonds. Let's get started. Bonds are loans that investors make to corporations and governments. The borrowers get the cash they need while the lenders earn the interest. Unlike stockholders who have equity or part ownership in a company, bondholders are creditors. When companies need to raise money to invest in growth and development, they can issue stock or sell bonds. They often prefer bonds because issuing stocks tend to dilute or lessen the value of shares investors already own. The bond is an IOU, or a record of the money they have lent and the terms on which it will be repaid. Investors can buy bonds issued by U.S. companies, U.S. Treasury, or by various cities and states, also from various federal, state, and local government agencies. Many overseas companies and governments also sell bonds to U.S. investors. When those bonds are sold in dollars rather than the currency of the issuing country, they are sometimes referred as Yankee bonds. Americans have more money invested in bonds than in stock, mutual funds, or other type of financial securities. One of the main reasons for this is that bonds pay a set amount of interest in a regular basis, giving it stability. Another attraction is that the issuer promises to repay the loan in full and on time at maturity. This feature makes bonds seem less risky than investments that depend on the ups and downs of the stock market. So how all this works? Every bond has a fixed maturity date when the bond expires and the loan must be paid back in full at par value. The interest a bond pays is also set the bond is issued. This could be monthly, quarterly, semi-annual, or annual. This is great because you are able to budget accordingly and manage your cash flow. The interest rate in a bond is referred as a coupon rate. Consider this example. Let's say a city wants to build a new sports park, so it decides to issue bonds to raise money. Each bond is a loan for $1,000 which the city promises to pay back in 5 years, and to make it attractive to investors, the city agrees to pay an annual interest rate of 5%, also known as a coupon rate, which is more than keeping the money in a savings account. So each year, the city pays the investors $50. Once the bond reaches maturity, the investors redeem his bond and the city reimburses the $1,000 principal investment. At the end, the city got the park, the investors made some passive income. Bonds are viewed as predictable, since it has regular scheduled payments and a set date for the return of investment principal, making it more stable than a stock, which depends on the volatile market. Although like any investment, bonds also run some risk. Like for example, the issuer default in paying the principal. Bonds with higher risk pay higher coupon rates. The amount of risk depends on the financial stability of the issuer. Most governments are considered lower risk issuers and issue bonds with a relatively low coupon rate. Corporate bonds typically present a greater risk of default as companies can go bankruptcy. There are bond ratings provided by Standard & Poor's and Moody's that can help an investor choosing a bond. These companies carefully investigate the financial condition of a bond issuer rather than the market appeal of his bond. They look at other debt the issuer has, how fast the company's revenue and profits are growing, the state of the economy, and how well other companies in the same business are doing. I will leave a link in the description below for you to download the bond rating chart. So we have discussed a bond's interest rate never changes, even though other interest rates do. If the bond is paying more interest than is available elsewhere, investors will be willing to pay more to own it. If the bond is paying less, the reverse is true. Conservative investors use bonds to provide a steady income. They buy a bond when it's issued and hold it, expecting to receive regular fixed interest payments until the bond matures. Then they get back the principal back to reinvest when it matures. When interest rates fluctuate, investors also trade bonds instead of holding them to make money. Bonds that are issued when interest rates are high become increasingly valuable when interest rates fall. That's because investors are willing to pay more than par value for a bond with a 10% interest rate if the current rate is 7%. In this way, an increase in the price of the bond or capital appreciation often produces more profits for bond sellers than holding the bond for maturity. I hope now you have a better understanding of the fundamental principle of a bond. Always consider informing yourself and consulting reliable investment companies before making any decision. Ask questions, ask questions, ask questions. I cannot address them more. If you enjoyed this video, please remember to like and subscribe to get alerts for our next video in topics related to business and money. Until next time.